There's a belief most people never question. Buying a house feels safe. It feels responsible. It feels like progress. It feels like you're finally doing the right thing with money. And that feeling is powerful. But here's the uncomfortable truth. A house can feel safe while quietly increasing financial risk. Not overnight, not dramatically. Slowly, almost invisibly. In 2026, that misunderstanding is more dangerous than most people realize. Society treats homeownership as a milestone, a signal of adulthood, stability, success. Renting is seen as temporary. Owning is seen as permanent progress. So when someone buys a house, they're not just making a financial decision. They're buying emotional security. They're buying certainty. They're buying the feeling of having arrived. And that's where the confusion starts, because emotional security is not the same thing as financial security. A house doesn't just sit there quietly. It demands things: debt, maintenance, taxes, insurance, year after year. Yet many people treat a house as if it's an investment first and an obligation second. They look at past price charts. They hear stories of appreciation. They assume ownership automatically builds wealth. But a house isn't a stock. It doesn't generate cash flow unless structured very carefully. For most people, it consumes cash. And in 2026, the cost of that consumption matters more than ever. Interest rates are higher than what people grew used to. Prices are still elevated relative to income growth. And inflation hasn't disappeared. It's just become quieter. Taxes rise slowly. Insurance premiums creep up. Maintenance never goes away. None of this feels dramatic in isolation. Together, they lock people into decisions that are hard to undo. That's the real danger. Long-term debt rigidity. Once you buy, your flexibility narrows. Your monthly obligations are fixed. Your ability to adapt shrinks. And the opportunity cost begins. Capital that could have been flexible becomes trapped, not just in the house, but in the lifestyle that comes with it. I've seen this pattern repeat itself. Someone stretches financially because ownership feels safe. They tell themselves it'll be worth it in the long run. At first, things are fine. Then life changes. Job opportunities come up, markets shift, expenses rise, and suddenly the house that felt like security feels like an anchor. Not because the house is bad, but because the timing was wrong. The decision limited options for the next 10, sometimes 20 years. That's the part most people don't calculate. They ask, can I buy this house? They don't ask, what does this decision prevent me from doing? Can I invest aggressively elsewhere? Can I handle a job change? Can I absorb a downturn without stress? In 2026, those questions matter, because uncertainty isn't temporary. Economic cycles don't pause for mortgage schedules. Buying a house today isn't just a bet on prices, it's a commitment to a specific structure of life and cash flow. That doesn't make it wrong, but it makes it serious. And before choosing ownership, the real financial mechanics need to be understood clearly, not emotionally, not socially, mechanically. Because once you see how the numbers behave over time, the question changes. And that's what we need to look at next. Once you strip away the emotion, the decision to buy a house becomes much simpler to analyze. Not easier, but clearer. I always look at housing as capital allocation, not as a lifestyle upgrade. That shift alone changes how the numbers behave. When you buy a house, you're allocating a large amount of capital into a single illiquid asset, often with leverage. And leverage magnifies outcomes, both good and bad. Let's slow this down and walk through the logic. A mortgage isn't just a payment. It's interest, it's taxes, it's insurance, it's maintenance. Every month, cash flows out. That cash has to come from somewhere. Now compare that to alternative uses of capital, investing in productive assets, stocks that generate long-term returns, businesses that create cash flow. Those assets may fluctuate, but over time they compound. A house doesn't compound the same way. Appreciation is not guaranteed, and even when it happens, it's offset by costs. The math doesn't scream danger. It whispers it. Illiquidity is the next issue. Once capital is tied up in a house, access becomes difficult. Selling takes time. Refinancing depends on conditions. Flexibility disappears right when it's most valuable. That's the opportunity cost. Money locked into a down payment can't be deployed elsewhere. It can't take advantage of market downturns. It can't be reallocated quickly. It's stuck. Now add leverage into uncertain cycles. Debt feels manageable when everything goes right. Income is steady. Expenses are predictable. But cycles change. Interest rates move. Jobs change. Markets slow. High leverage reduces margin of safety. And margin of safety is what keeps stress low. The cause and effect chain is consistent. High leverage leads to tighter cash flow. Tighter cash flow limits investing. Limited investing reduces long-term wealth building. And over time, pressure builds. When people ignore this framework, the outcomes are predictable. Budgets stretch, savings rates drop. Investing gets postponed. Next year becomes a habit. Adaptability suffers. Job opportunities get passed up. Relocation becomes difficult. Risk tolerance shrinks. This is where risk needs to be reframed. Risk isn't home prices going down. That's visible. Real risk is inflexibility, personal financial fragility, and a stable-looking asset. A house can be stable in price and still destabilize your finances. That's the paradox. None of this means buying a house is always wrong. It means timing matters, structure matters, and understanding consequences matters more than comfort. The numbers don't punish instantly, they apply pressure slowly, which is why this decision needs to be examined in the real world. Because theory only goes so far, and the real pressure shows up in everyday life. That's where this becomes real. This is where the decision stops being theoretical. Because in 2026, people aren't choosing between a spreadsheet and a textbook. They're choosing inside real lives, with real pressure and real consequences. Time changes the meaning of this decision more than almost anything else. Buying early feels like locking in certainty. You tell yourself, if I buy now, I won't have to worry later. But a long-term mortgage doesn't just lock in a price. It locks in decades of decisions. Monthly payments shape cash flow. Cash flow shapes investing ability. And investing ability shapes long-term wealth. If you buy early, you trade flexibility for perceived stability. That trade can make sense, but only if the structure supports it. For younger buyers, flexibility is often the most valuable asset they have. Careers are still forming. Income can change quickly. Opportunities aren't always predictable. A heavy mortgage early on limits how fast you can adapt. You might pass on a better job because relocation is hard. You might delay investing because cash flow feels tight. The house becomes the center of the financial system, not one part of it. For mid-career buyers, the pressure is different. Income is higher. Responsibilities are heavier. There's a desire for stability, for roots, but opportunity cost becomes larger. Every dollar tied up in housing is a dollar not working elsewhere. And at this stage, compounding matters more than ever. Delaying investing by 5 or 10 years is no longer trivial. That delay compresses the future. Modern pressures make this harder. Social pressure is constant. Owning is celebrated. Renting is questioned. People post keys, houses, upgrades. Rarely the debt, rarely the stress. There's also the fear narrative. If you don't buy now, you'll be priced out forever. That fear pushes emotional decisions, and emotional decisions tend to ignore structure. Online success stories amplify this. Real estate wins are shared loudly. Losses are quiet. What you don't see are the people who bought at the wrong time and spent years financially constrained. This creates a powerful contrast. The disciplined allocator looks at housing as one part of capital allocation. They ask, what does this do to my margin of safety? They rent with intention. They invest consistently. They keep options open. The emotional buyer focuses on ownership first. They stretch. They assume appreciation will solve everything. They hope income will rise fast enough. Sometimes it works. Often it just adds pressure. Small decisions compound here. A slightly higher mortgage means less monthly investing. Less monthly investing means fewer years of compounding. Those missed years don't come back. Opportunity cost compounds too. Let me walk you through a simple scenario. Two people, same age, same income. One buys a house immediately. Large down payment, high monthly obligation. The other rents intentionally. They invest the difference. They stay flexible. 5 years pass. The homeowner built equity, but cash flow is tight. Investing was sporadic. Stress was constant. The renter invested consistently. Their portfolio compounded. They didn't avoid volatility. They absorbed it. Now, options diverge. One feels locked in. The other feels adaptable. Neither choice was reckless. only one preserved margin. This isn't anti-home ownership, it's anti-rushed ownership. Timing matters, structure matters, discipline matters. The safer move is rarely about status, it's about behavior. And once that becomes clear, the decision stops being emotional and starts becoming deliberate. That's where the real difference is made. This is where everything comes together, not as a warning, not as a rule, but as a decision. Over time, I've learned something simple. Patience often beats participation, not because patience avoids risk, but because it preserves control. Most financial mistakes aren't made because people lack intelligence. They're made because people feel pressure to do something, to participate, to keep up, to prove progress. Buying a house can easily fall into that category. It feels like a finish line. But in reality, it's a long-term commitment that shapes decades of behavior. Financial safety doesn't come from ownership status. It comes from flexibility, from margin, from having room to breathe when life doesn't go according to plan. That's why behavior matters more than brilliance. You don't need to predict interest rates. You don't need to forecast housing prices. You need to protect your ability to make good decisions later. Long-term wealth is rarely built by locking yourself into one path early. It's built through adaptable capital allocation, money that can move, money that can respond, money that can compound quietly without forcing your hand. That adaptability is what creates real financial independence, not the house itself, but the options you keep. So what is the safer move in 2026? It isn't dramatic. It doesn't photograph well. It's delaying the purchase until the structure makes sense. It's strengthening cash flow before committing to long-term debt. It's investing in productive assets first. Assets that grow, assets that compound, assets that don't demand constant cash outflow. It's making sure that when you do buy, you're doing it from strength, not pressure. That takes emotional control, resisting social narratives, ignoring fear-driven headlines, understanding that renting with intention can be a disciplined strategy, not a failure, understanding that waiting can be an active decision, not avoidance. I'm not saying never buy a house. I'm saying don't rush into one because it feels safe. Ask better questions. Why do I want to buy now? What am I giving up in exchange? How does this decision affect my flexibility? If the answers are clear and the margin is strong, ownership can make sense. If they aren't, patience is not weakness. It's strategy. The biggest advantage you can give yourself is optionality, the ability to move, to invest, to adapt. That's what protects you in uncertain times. And that's why in 2026, the safer move isn't about buying or not buying. It's about deciding calmly, with discipline and a long view. No fear, no hype, just clarity. And clarity over time is what builds wealth.